Dick's Sporting Goods and Best Buy reported earnings this week, and our community really likes these stocks. I'm going to hit them and go into their earnings, go into their financials, go into the stock analyzer tool and see what I would pay for them. Go on. So Dick's Sporting Goods, let's start with that one. Revenue came in $2.96 versus the $2.68 expectation, so that's a beat. Earnings per share came in $2.60 versus $2.27. Comparable store sales, you guys know this is important for retail, up 6.5%, which is huge, especially in this time when a bunch of the other retailers are really seeing some suffering. You're seeing Target and Walmart having comparable store sales that are actually falling down. Forward guidance is up on earnings per share, up on comparable store sales, which is absolutely impressive to me. So let's get into some numbers and see what's going on with Dick's Sporting Goods. So right off the rip, it is up nearly 6% on those earnings. So that's a good thing, depending. For me, it's probably not a good thing because I probably want the stock lower, and probably some of you don't want to pay this price either. Now, the first thing we're going to look at, $8.37 billion company. I want to point something out real quick. The dividends paid. The dividends paid right now is $621.67 million, 7.4%. That looks really great, but to me, this is almost a dividend trap. They have an average free cash flow over the last 5 years of $700.26 million. So basically, they're paying all of their free cash flow going into that 5-year average, which is not sustainable. And the free cash flow currently is not even, it's almost half, $379.5 million. So that right there is screaming alarm bells to me saying, hey, wait a second here. Now, if you're a value investor, you might like this. Why? Because maybe they're going to slash this thing 60%, which will do what? Well, it'll take that stock price of 117 and it'll certainly crash it because people do not like when dividends are slashed, especially dividends that are paying 7.4%. Why? Because they don't understand that the dividends paid comes out of the cash flow. That's exactly why. So they would actually have to probably take out some debt to do that or do some type of share dilution, whatever you have to do. Let's go to the income statement. Now I'm going to have to taper, when I go to my stock analyzer tool, I'm going to have to taper this because look at this. Let's go back 10 years. $6 billion, $6.5 billion, $7 billion, $7.5 billion, $6.25 billion. I'm sorry, $8.25 billion, 8.7, 8.53, 8.62, and then what happened? COVID, 11.73, 11.91. This is not sustainable, in my opinion. I would probably look and say, okay, maybe we'll go back and maybe they could do $9 billion in revenue. Maybe that's baseline. But when I do my stock analyzer tool, I'm going to have to decrease my revenue expectations just a little bit just because they had that big jump. I think things will start to cool down. Let's go to their net income. Same thing on net income. Pretty consistently making in that $300 million range. And then all of a sudden, $1.25 billion, $1.24 billion. Again, probably not sustainable, even with the great earnings report they came out with, comparable store sales being up, forward guidance being up, probably not going to sustain those levels. Now, they have been buying back shares and pretty aggressively over the past year, really. Do I like it? We'll find out when I run Stock Analyzer tool. I don't remember seeing them do any acquisitions. Nope, and I wouldn't expect them to. Let's see what the analysts have to say on Dick's Sporting Goods. So they see low single-digit growth on earnings per share over the next 5-6 years. And on the revenue side, it's very low, probably an average of 1% over the next 5 or 6 years. So when I put this in Stock Analyzer tool, again, with and it goes back to this. It goes back to this consistency and then this big jump. They're probably not going to do a lot, especially when they have to come down from that nearly $12 billion. So let's go to Stock Analyzer and throw this in there. I'm going to do -2, 0, and 2% over the next decade. Profit margin, I will do 5.5, 7, and 8.5. Let's run the gamut there. I'm going to do the same thing for price to free cash flow. It is pretty similar, 8.5. You know what? Before I continue on, let's go look at the 8 pillars. Didn't even check those out yet. So these tell me something is good. The debt, not really concerned about. Why? Because they have a lot of capital leases. This is so much retail. They have so many places in malls and shopping centers and whatnot. So this number, it's barely over our 5 on debt for the 5-year average. Doesn't really bother me. The cash flow, however, yeah, that bothers me, especially with that dividend. Does bother me with that dividend. So let's go back to Stock Analyzer and continue here. PE, 11, 13, and 15. 11, 13, and 15. I think 15 could be a little high. 12.5% return on the low end. 14.5 in the middle ground, and 16.5 on the high ground. And current price is $113. Let's see what we come out with. Okay, so just because these numbers are all red doesn't mean that it's not a good buy right now, right? This is just my assumptions. If I could start going in and putting assumptions in here of, say, 6% revenue growth. Let's see what comes out to. There you go. It's a good buy today if I put in 6% revenue growth on the high side. Now, I don't think that that's reasonable, so I'm going to stick with that 2%. And this is the idea of Stock Analyzer tool. You put in assumptions that work for you. Maybe you see something in the company that I don't see. Low end of $51, high end of $92, middle ground of $70, and you can see it's on my watch list for $90. Why is it on my watch list for $90? Because I'm probably interested in buying this around $65 or $70 if I do some type of purchase on it. And this price right here will give me options to sell puts at much lower prices. So with Dick's Sporting Goods, find out what's going on with that dividend and really understand what's going on as far as if they're going to cut that dividend and what it's going to do to the stock price, because that cash flow is a little bit concerning. Now, Best Buy. This is a company that I owned in the past. They came in, reported a revenue of $10.58 billion versus $10.31 billion expectation. Earnings per share $1.38 versus $1.03. And you can see today, because they had that top and bottom line beat, it is up 10%. Now, when I look at a company like Best Buy, if I had to guess, I would have said, all right, they have a couple things going against them for this specific earnings report. And this is why I would not be involved in them trading them. It's retail. Everywhere in retail is getting hit. It's tech. Everywhere in tech is getting hit. This, to me, is a crazy, crazy stock price reaction. It could have just as easily gone down 10%. They even came out and said that their same-store sales could drop somewhere around 11% over the next year. Because, why? Well, they're coming off of this COVID high. You can see consistently $40 billion, $43 billion. They had a pretty good jump there. And then all of a sudden, 52 and $49.25 billion. Guys, they have, just like Dick's Sporting Goods, they need to control their revenue. It needs to come back down. Now let's go to the 8 pillars and flash this real quick. Cash flow, again, is a concern. Everything is looking good. Actually, the debt side, that surprises me just because of their capital lease obligations being in that industry, but the debt is a little bit concerning. Dividends paid. So with a company like Best Buy, their trailing 12-month free cash flow is $824 million, and they're paying the majority of their cash flow to the dividend. It's not super concerning for me because it's such an established business. What else are they going to do with their capital? They have been buying back shares. They're paying out a dividend. Now, this is too much. This is definitely too much. And I think that if they probably cut this dividend maybe 25%, it would be in a better spot. But they can easily afford it based on their five-year average. Revenue growth is obviously there. Net income growth is obviously there. But you're going to have to taper those numbers when we look at Stock Analyzer tool. Analyst estimates. Wow. Mid-teen earning per share growth over the next 5 years, which is very surprising to me. Okay, revenue. That is not surprising to me. Revenue growth, very flat over the next 5 years, which is, again, not surprising. So let's go to Stock Analyzer tool. And I'm actually going to put in, -1, 0, and 1. Well, that should be 0 and 1. Profit margin. They've held their own with that. Let's go 3%, 3.5%, and 4% on the high side. Maybe 4 is a little bit high. You know what? Let's go 2.5, 3, and 3.5, and 3.5. All right. Free cash flow margin should be right in line over a long period of time. PE, 11, 13, and 15. Same thing for price to free cash flow. And let's go 12.5, 15, and 17. And the reason I did that, they have faced some financial troubles over the past several years. They've had to bring back their current CEO multiple times to pull them out of almost bankruptcy situations. So it's not the best managed business outside of the current CEO and founder. So $78 is the current price after being up 10.5% today. And to me, I'm looking somewhere in the $45.50 range to $65.50 with a middle ground of about $54. And I will probably add this to my watch list to start buying somewhere sub 40. And you might say, wow, that's incredibly low. Well, I'm not totally convinced that this business is going to do even this side. I think that their revenue growth could be a lot less. Their profit margin, as inflation continues, as chips become more expensive, as if they start building all of these chips for things in the United States, profit margins could shrink a little bit. Now, 2.5% is very low. But for me, I'm probably looking at this thing to acquire it somewhere around 40 or below, which, again, might sound crazy, but this is a company that I look at and go, yeah, it's a good business. If I can get it at a really good price, sure, if I can get it cheap. But there's 10,000 other companies out there in the U.S. Why would I fight to own this thing when I can go and buy something else? So if you like this, guys, smash the like button, subscribe to the channel, and I will see you next time.